All right, team. Happy Tuesday. A little bit later today with the update. A lot going on today, which is good. Having some fun with some things. And was that going to work? No? Not going to work? There it is. Trying to figure out these buttons. No, you're too kind. Thank you. No, thank you. Getting things fired up. Wow. You guys are an amazing audience. This is truly something else. I have some stuff to share with you today. Now, you're not going to be surprised by a lot of it because I've been telling you these things have been going on for a long time, years really. Just going to go ahead and share here real quick. But I do want to show you what's happening because some good news on the mortgage rate front, as we predicted. And then we have activity taking place in the financial markets is very interesting. What's up, Carlos? Great to see you as well, my friend. Say hi if you want to. Derrick Evans here, a home loan specialist. NMLS 155010. You can call, text, or email me with the information on the screen. Happy to help. That's what I'm here for. Let's take a look at mortgage rates. Let's dive in because this is chart formation that has been building up. This was the Fed day right here. This really big ugly guy. And remember, we want mortgage bond prices to go higher because that would mean lower interest rates. So we want to see this thing moving in this direction. And, just recently we've kind of been going in this direction, not the direction we want to be going in. So, we had the Fed speak here. That was bad. I think that was a pre-planned move. And I think big boys made a lot of money that day. But bottom line is you could see these wicks here that buyers are in there stepping in. And when I say buyers, I mean, of course, the Fed. And that's pretty much it. Let's see if this works. Oh, no, is it this one? No, I don't know. I'm about to figure that out. But the good news is, we're almost back now to where we were. So this is where we were, prior to, actually, technically, this is where we were. This is where we closed the day before the Fed spoke. So we're not far away, just a few basis points away from being back and recovering all of that in just a few days. So that's a very good sign for mortgage bonds. Who cares who the buyer is? Really, really good. 20 basis points today. And if we get another 20 tomorrow, we're easily going to be through this. Now, I think that we're going to be able to sort of rely on this area right here being an area where we should be looking to lock. So if we get anywhere in this area, that's a lock. So if you're refinancing, that's sort of our target is right in here. If we get in the side of there, we'll want to push the lock button, and we want to push it pretty feverishly. If you're purchasing, then you want to go ahead and lock here because you can always float down. At least you can with me. You can float down if the rate gets better, up to 0.25%. But you can always float down if it improves, and it very well may improve a little bit, but probably not enough to change the rate. This may not be enough to change the rate on a purchase. Hard to say, but it definitely for a refinance, if you have the time and you can wait, it may take several days to get over here. You can wait till you get in there and then see what happens. Remember, as a refinance, you don't have that gun to your head. You don't have that timeline. You can wait and see what happens, and maybe it busts through there. And maybe it takes a week or two, but maybe it busts through. This is going to be a very congested and high traffic area. It's going to take some time to break through these three seals here. There's our three major moving averages that mortgage bonds have to get through. Facing already a lot of inflationary headwinds, it's going to be tough to breach that. But it may happen, and it may take let's say 1 to 3 weeks. And if that happens, then it'll be a great opportunity to lock your refi. So what I'm encouraging people to do right now, get your refi going, get your appraisal done, because appraisals are looking great right now. I mean, you've got great comps. Homes are selling for a lot of money. So it's a good time to get your appraisal done, which is you got 6 months for that appraisal before it expires. That's plenty of time to find the next window to lock. And then you just get the loan ready to go, you lock, and that's how you do a refi in this market. Okay, let's take a look. Let's go financial markets real quick before I show you a couple stories I think you should see. So not a lot of movement in the markets today, except for the NASDAQ did hit an all-time high today. And closed, in fact, at a record, which is sort of mind-boggling. But at the same time, this is the market that we're in. And a lot of people don't realize that, there's certain things that are sort of rigged in the favor of going higher. You look at Bitcoin, which let's actually look at Bitcoin today. Okay, so at 32,000-ish, low 30s. It did dip down below 30,000 today for a short period of time, and everyone was freaking out. But Bitcoin is organized in such a way that it's going to go higher over time, which is why it's gone from less than a penny to $32,000 per coin. And the same thing with the stock market. I mean, the stock market, you got to realize, people's 401ks and, there's automatic money going into the stock market automatically every day. Lots of money is being pushed into the stock market from people's retirement accounts and automatic investments and stuff like that. So there's tons of money always coming in the buy side of the market with stocks. This is why stocks, and it's a population play, continue to go higher over time. Same thing with real estate. Oh, we want to talk about real estate? Hey, guess what? And I really don't watch or pay attention to Zero Hedge very often. I don't know really anything about this site, but they did some great research on this and found out some information. So America's largest landlord just got bigger. Blackstone, which we talked about last week. Remember, these are the guys who bought the houses in Texas for, I believe it was one of their pension funds. Blackstone's huge. They have a bunch of different types of funds, trillions of dollars under management. It's crazy. They bought 17,000 houses. What's really interesting is that they bought it from this company that's called Home Partners of America. You can look them up. What Home Partners of America does is, let's say you don't qualify to buy a home for whatever reason, or you don't want to buy a home for whatever reason just yet, or maybe you don't have a down payment or whatever. They would actually have you go shop for a house, find the house that you like. They buy it for you, and then you rent it from them for a certain amount of money. And then they give you the option to buy it down the road. And it's a really interesting concept. In fact, someone came to me with this concept, and I was like, man, that's really complicated. I don't think it'll work. And then this company absolutely blew up, and they sold their portfolio for $6 billion, which sounds like a lot of money, but think about it from Blackstone's perspective. They have $325 billion in real estate in their portfolio. $325 billion. So the $6 billion acquisition is really just 2%. It's 17,000 houses. Now, they will have to honor those contracts for these people, although I guarantee you their intention is not to let these people buy these properties. They want to rent them. And so the reason why this is important, a lot of people right now, not really sure. A lot of buyers getting fatigued by the market, and I totally understand that. But a lot of people talking about, hey, is this a crash? Is this what a crash looks like? Look, Derrick, you're telling us Wall Street's buying real estate. They're running the prices up. The difference is when shorting real estate doesn't really work. You can do it. It's been done. But it doesn't really work if you own the underlying asset as well. So like you could hedge a short against your underlying real estate if you were going to crash the market. That could be one thing that they could be playing. But though that would be a very difficult game to play, to go huge on the buy side and then turn it around and do a bunch of CDOs and try to short it. That would be a very difficult play to make that I don't know. I really don't know how that would work. Honestly, you would be writing the paper to yourself. It's kind of like, well, if you're going to buy something and then sell it, why do anything at all? If you're literally going to do it in the same market. So I don't know. If we started seeing stories where Blackstone was selling homes by the thousands, we'd have something to talk about. But I don't think that you're going to see that happen. I don't think you're going to see that happen because look what they're doing. They're just acquiring more and more and more and more and more. Here's also something that was interesting in here. Single-family rentals have been a favorite institutional bet over the past year. A favorite institutional bet is a really interesting way to put that because it's definitely true. As a real estate investors have sought new places to invest during a pandemic that kept Americans away from offices, hotels, blah, blah, blah. The result, as the Wall Street Journal reported, link, has been a frenzy among 200 companies and investment firms who have entered the house hunt. Okay, this is really interesting because JP Morgan, BlackRock, Fundrise, Roofstock, these other ones that are LGI Homes, they're listing out some of them. These are firms that are buying houses in a major way. So if you were an individual, let me ask you a question. If you were an individual, would you want to follow the big Wall Street firms when they're putting enormous amounts of money into a trade? Or would you want to stay away from it? In other words, if you saw, and this is kind of what we expect to see with Bitcoin before the end of the year, if you saw a Wall Street firm after firm after firm after firm newly getting into and buying Apple stock or something. That one's obviously been around for a long time. But if we go back to when that happened, these huge Wall Street firms started getting into it, would you want to follow them into that? Or would you want to say, no, I'm not interested? I like riding Wall Street's coattails personally. It's just like, we didn't look at it, did we? It's just like oil, right? $73. We've been talking about this since it was 45, right? This is going to 100. I'll start selling some at 90. Gold, I just like to look at because it's interesting to me to see what's going on with it. Still below 1800, not really going anywhere. And we looked at crypto, and we looked at the U.S. stuff. I'm not following Asia or the EU or anything. But this frenzy among 200 companies and firms. So people have been saying, but Derrick, those guys are running up prices in real estate. Wouldn't that be a problem? Isn't it Wall Street? You've always told us that once they get their hands on something, they run it into the ground. They definitely do when it's paper. Here's what's different. And this is super, super important. Please understand this. This is high. I know this is high level stuff, but understand the difference here. Before the crash, Wall Street was selling the paper. They were selling the paper that was associated with shitty mortgages and therefore bad loans, bad real estate, right? If you have, if you're moving paper around in real estate and you have a bad loan, it's a bad deal. That's what Wall Street was doing before the last crash. What they're doing this time is they're buying the houses. They're not buying the paper. BlackRock could easily just buy the paper. If they wanted to make, a little bit of money and have it be pretty seamless, they would just buy the paper. And what I mean by that is they would buy the loan. They would become the servicer. So when you do a loan, it gets packaged up into let's call it a piece of paper. A piece of paper that says, hey, we have the rights to this loan. We own this loan, or we're the servicer on this loan. And there could be an owner of the loan that's different than the servicer. Sometimes an owner of the loan will sell the servicing rights to someone, but they'll still hold the paper. Meaning if something goes wrong with that loan, they're holding the bag, right? So there's two different ways you can go about it. You could sell the paper and sell the servicing, or you could just sell the servicing. So they could buy the paper, they could buy the servicing, they could do that all day long. This is a regular open market where this happens. That's not what they're doing. They're buying the actual freaking houses and renting them out. That's what they're doing. So, if you had said, well, you don't want to follow Wall Street into this or that because this happens. If you had done the same thing that Wall Street did in 2008, you would have got rich too. If you'd bought the paper and flipped it to countries and municipalities who didn't know any better, you would have also made a ton of money. You probably would deserve to burn in hell, but you would have made a ton of money. If you look at this and we go, okay, well, what are they doing? They're just buying freaking houses and renting them to people. That's it. Why do they like it so much? I'll tell you why they like it so much. Same reason everyone should like real estate so much. It's because they're going to get in with a fixed cost, right? They're going to buy the house for X dollars. Remember they paid 50% above the listing price for that whole neighborhood, that brand new construction neighborhood in Texas we talked about last week? Why would they do that? Because they're going to pay a fixed cost and then they're going to increase the rent on a parabolic level. They're going to increase the rents 2.5% or 3% a year or 5% a year. So the income that they have is going to be parabolic. The cost is going to be flat. So even if it takes a while, I'm not drawing this very well. Do I have the right tools to draw this for you? Parabolic increase in revenue, flat cost. Okay, it's the same reason why you want to own a home versus renting, because when you rent, your cost is parabolic. This is what they've realized. Wall Street has realized that the increase in rents, it has such a huge move that it is basically parabolic, almost. Parabolic would mean it's heading into infinity, so it's not exactly parabolic, but it is looking like that. It is not just a linear move higher. It has oomph to it. And because of that, if you can get into it with a fixed cost, you're great. You're golden. Now, same thing when you're buying a home, you're trying to avoid that increase. You're trying to avoid that increase in costs by hedging and purchasing and saying, okay, my payment's going to be right here. So I may have to pay $3,000 or let's say $3,500 a month instead of, where I could rent for a few $100 a month less. But 5 years from now, how much more in rent am I going to be paying? And if I had just bought the house, I would still be paying that flat amount. It's a hedge. So that's what's going on. And you can see the results here. And this one is from the Wall Street Journal. Existing home prices hit record high in May, and they're saying that it was up 24% year over year nationwide. And this is another thing that, here it is. So National Association of Realtors, here's the data. I'm going to give you both these articles. 24% higher than a year ago, so year over year. According to Redfin, in San Diego, it was 19.9% or 20% year over year. So again, makes no sense. First of all, real estate from an inflationary standpoint is trailing all kinds of stuff. There's so many things that are, and I'm not just talking about lumber or the things that are associated with real estate. I'm talking about gas. I'm talking about oil. I'm talking about all of the commodities, the grocery store, everything in there. These things are all up way more than real estate. Real estate up 20%. So if we look and we say, okay, well, let's use that as our inflationary figure, then that shows you the reason why Wall Street is buying real estate, because obviously, not just for appreciation purposes, we talked about the parabolic rent curve, those things are all coming into play. They're all coming into the decision-making process that's going on. And real estate is behind all these other things. It's due for more of an increase. It's way behind. And so I totally expect we will continue to see the same thing. Good question, Robert. Thank you for that. But are they buying in San Diego? It's a great question. And the answer is abso-freaking-lutely. Now, it's harder because I'll be honest with you, the thing that they really like is new construction. They like newer construction. But this purchase that they just made, that BlackRock just made in with Home Partners of America, is homes all over the country. And they're not necessarily new construction. So while they prefer that, they're starting to dip their toes further into some of the other kinds of things. The other reason why you're not seeing them purchase as much in San Diego is because, remember, from a rental standpoint, San Diego does not have the highest margins for investment properties. Like, you can go and you can buy houses in the Midwest or, really anywhere and get a higher margin return on your investment, from a cash on cash perspective, just a ROI, straight annual ROI. In San Diego, what's appealing is that you can get more appreciation. And so, if they're looking at this as just a straight rental play, they're going to be more apt to look in other lower cost areas to pick up more homes. Let's do the math. So they got 17,000 homes for $6 billion. Let me break out my calculator. So 6 billion, 1, 2, 3, 1, 2, 3, 1, 2, 3, divided by 17, 1, 2, 3. Average cost on these homes, $353,000. So the homes that they picked up from Home Partners of America, on average, cost $353,000 to them at that purchase price. So they're not buying houses in San Diego for that. It's just not happening. But thanks for chiming in, Robert. It's always good to hear from you. Feel free to drop a comment or say what's up if you're catching us live here. And back to this. So if the nation is at 24% and San Diego's at 20%, what the hell sense does that make? Does that make any sense? Okay, here's why it does. Because these lower price points in different areas are causing those areas to rise a little bit higher. If you throw an extra 10 or 20 grand on a home that's $250,000, that's a big percentage. Whereas here in San Diego, it's nothing, right? It barely moves the needle. So you have to consider that the percentage is going to be higher in some of the other areas, but it shouldn't be. I mean, it makes sense as to why that's the case, but it really shouldn't be. It really shouldn't be. But this is why there's a diminishing return. A lot of people say that this is what's going to happen with Bitcoin. It won't go to $1 million because, once you get to a certain price point, it becomes too much to get really a return. If it's at 500, if it's at 300,000, now it's really hard. In order for you to get 10 times your money, it's got to go to 3 million. That's hard. That's a long journey, right? And so you'll see that in like penny stocks, lower price stocks, the smaller cryptocurrencies. And now you're seeing it in real estate in some of the lower price areas. So it makes sense why it's happening, but it also, from an investment standpoint, it's wrong. It's definitely wrong. I promise you, we will know when the market starts easing, and I expect this to happen the next, this is not for 3 or 4 years, but let's say in the next 5 to 10 years. The market will know when the market starts easing, when these other areas start to soften, when you start to see things flatten out in Missouri and Iowa and Kansas and Arkansas, when you start to see those things level out a little bit, when you start, Idaho is going crazy, Wyoming, it's ridiculous, Montana is nuts. Look at real estate some of these places if you don't believe me. I'll have a fun time. I'll do a fun show one time, and we'll look at some of the real estate in these different places. You will be blown away what people are paying to just be in the middle of nowhere. I mean, it's like, I wonder if some of these people have ever been to a beach or seen the ocean. What are you doing? Listen, if you're buying $1 million house in Montana, I promise you, it's going to be awesome. It's going to be sick. And maybe that'll be the perfect life for you. But you should really look at what you can get in other places, especially America's finest city, which I'm partial to. All right, I'm going to get back to it, team. Thank you so much for your time. Drop comments, share this with your friends. Let's make them smarter than everyone else. Good question. Define easing. Easing means that the craziness starts to slow down a little bit, meaning that the mania chills out. There's not multiple offers. Prices aren't going up every day. And you start to see things just easing a little bit more makes sensical. Like, we're listing a house for $700,000, it's selling for $700,000 or $695 or $705. Not you're listing a house for $700, it's selling for $800. We need to see that ease a little bit first, meaning just come back to where we think a more normal market would look like, where homes are selling around, the list price or close to it, and there's less of a mania where people are just going crazy and offering way over the list price. That's the first step. So we've got to see that first. So that's what I mean by easing. Hopefully that helps. All right, team, have a great day. Talk to you soon.